saw some data came out that's a little bit delayed here, but it's about the first kind of 6 months of the 2025 is in the book. So there's been some good data here. And interesting, I want to break down that the glut of businesses is stacking up here. So volume is down 14% year over year. And smaller transactions, with meaning less than $10 million of enterprise value, are down 18%. So this is just showing that as interest rates have gone up, there has been a slowdown in M&A activity overall. But what's interesting is that valuations are actually holding strong. And so what that's saying is that if you are a well-run business, people are willing to continue to pay valuations that are at the higher end of the historical range because the valuations aren't moving down, but just the sheer number of deals getting done is smaller. So what are your thoughts overall on just kind of some of this data here? And we got a chart that shows the historical M&A volume, and it's overlaid with the Fed funds rate just to kind of show that maybe as interest rates go up, historically transactions have come down a little bit.
Yeah, I think that's normal. Cost of funds and all other types of reasons why you're going to have slower and less transactions when you have interest rates go up, especially as dramatically as they went up most recently. And yet, on the other hand, there's so much money in the wings. There's so much cash looking for a home in the M&A world, just like there's so much cash anyway. I mean, you look at the cash on the balance sheets of Americans, it's a huge number. It's into the trillions. And because of that, that money's looking for a home. So in the M&A space, it makes total sense to me that the well-run companies are still going to demand a significant premium or a valuation that's warranted. They're not going to take a hit there because this money is looking for a home.
Right.
And if you're one of those well-run companies, you can expect a really good price.
Yeah. I mean, so middle market's defined as less than $500 million here. This data is all from Percent, which Mark Herbick there, a good friend. 7.2x EBITDA is the middle market average valuation, up from 7.1x in 2024. And then bigger companies deserve a higher premium. And so we've got some data here that if it's a $10 to $25 million total transaction, the average EBITDA is 6.3x. $50 to $100 million, it's 8x. And then $250 million to $500 million, it's a 9.7x. And that really just, think of finance risk return as the way I like to describe this to entrepreneurs. The lower the risk in your business, the more that business is worth because you are taking risk off the table. So therefore, someone is willing to pay a higher price because at the end of the day, someone needs to get compensated for the amount of risk they're taking. So if your business is very poorly run, if you can even get a deal done, it's going to be at a lower valuation because if it's successful, the buyer needs to make sure they get a huge return. How do they get a huge return? They buy it for less money. So we're seeing some data there. And then the other thing I want to just talk through is EBITDA range. So that was based off of the total enterprise value. But if you're a $3 to $5 million EBITDA, 6.6 is the average. Again, this is very industry dependent. $5 to $8 million, 7.4x. Over $10 million, 8x. So again, huge disparage range here based off of the industries you're at. So healthcare, business services on the higher end. If you're in construction, anything like that, you're going to be a lot on the lower end.
Yeah.
So
CPA firms,
those
are on the lower end too.
So we've got some charts here, chart 2, chart 3 that we're going to throw up that just shows the data here of where we're pulling these figures. So what are your thoughts on just valuations overall holding steady and then really valuations by EBITDA range?
Yeah, I think it makes sense. And I think the bigger you are, the more you're worth generally. And your point, which is really the key point, is risk.
Yeah.
And that's why entrepreneurs who their business is too dependent on them, too much risk, right? Something happens to one person, and that's not just hit by the proverbial bus, but maybe you're going through a divorce, back to our prior conversation, or you have a health problem. So you rely on one person, there's a lot more risk for that buyer. And then also things like reliable, predictable income and being able to project your future. So I know I've given talks about P&Ls and about having a model P&L and about budgeting, and that the more you can show that you can predict the future and then make those numbers come true, the more likely a buyer is going to go, okay, well, you've proven that you can rinse and repeat this profitability margin, this profitability and growth train. So I'm willing to pay more because I have confidence that my risk is low, that's not going to disappear anytime soon.
Yep.